Hi, everyone. This is another session of Let's Talk About Regulation. This time we are not doing it live because there was an issue with the recording, but we still wanted to share the content with you and with those that couldn't join that day. So we are recording this again. With us today is Tommaso Astasi, who is the head of the regulatory affairs at Blockchain for Europe. Blockchain for Europe is a Brussels-based trade association that represents the blockchain and the crypto ecosystem. They were really close with us at IOTA and also at INATPA. We have been collaborating in different initiatives. The latest one was the Data Act. Tommaso has a huge experience on different tech and sustainability topics. He was working on AI, data privacy, and sustainability reporting. And at the end of 2021, Tommaso managed to merge his professional experience in the European public affairs sectors with his long-standing interest in the blockchain technology. And that's how we got to know each other. So without more delay, I'm going to hand over to Tommaso so he can move forward with the presentation. Again, Tommaso, thank you very much for being with us on the session last week and recording this again.
Thank you, Mariana. Thanks everyone for joining last time and for listening to this recording again. It's great to be here. And, thanks for the great introduction. As Mariana said, I think we have been quite active in working together on a lot of different initiatives in the past few months because there is a lot of things to do in the public affairs and regulatory space for the blockchain sector. And so this presentation and the chat I'm gonna give today is really all about that, right? So how is this regulatory framework, regulatory environment for crypto asset markets and blockchain technology being shaped, especially, of course, with a focus on the European Union, because that's where we are based and focusing on, but also mentioning a bit of the global trends and what's happening on global stage and what is happening in other jurisdictions, maybe just as a comparison point. Let's say what is not happening when it comes to regulation or at least development of our clear regulatory framework for crypto assets. Without further ado, I think we can go into the bit of the presentation. This is just to show you what we are gonna cover today after this intro and talking a bit about the global regulatory context and different global institutions and organizations that are driving somehow the approach towards the regulation of crypto assets. And then we're going to focus, as we said, on the European Union regulatory approach. Some of these files, let's say, and regulations and laws that you're going to hear about today, I'm sure it's not the first time you hear about. First and foremost, the MiCA regulation that, of course, is being discussed and talked about throughout actually the European Union, but also quite globally speaking, as a very interesting example of an approach towards crypto regulation. So we're going to mention that, of course, but that's the whole point here is that MiCA is not the only one, and there is a lot of other pieces to this puzzle that the European Union is putting together, trying to develop a clear regulatory framework for our ecosystem. So after this quick intro, I think the interesting starting point is really to try and look back at the evolution of this crypto asset market from a regulation, and it's the relationship between crypto assets and the crypto ecosystem and Web3 and regulation. So as you all know, I'm sure remember, if you're around back then in 2015, 16, 17, the global crypto world and ecosystem was defined as this wild west of cryptos, right? So the idea that this new technology, this new market, these new projects were launching all around the world, popping up with ICOs and promising great initiatives and projects. A lot of times these being maybe not even as serious as they pretended to be, and so this idea that you could easily just launch a new project. There was no rules that would impact you. There was no clear way of, for example, launching a new token by complying with exactly all the applicable regulations around your jurisdictions and so on. The idea that really there was no clear regulatory framework for crypto assets and crypto assets projects. The idea was also because the crypto asset market itself and the ecosystem was somehow refraining the concept of regulation, right? So the idea that we cannot be regulated, we will not be regulated, which sounded almost as a challenge to the regulators, right? So if we look back at this last 5 years, basically a lot of things have changed in that sense, right? So if we were in the ecosystem trying to escape regulation as much as we could, because we just didn't believe that traditional regulatory frameworks, rightfully so, I would say, could not apply to crypto asset markets and crypto asset products and services. But then in the past few years, something changed. Something really important changed, which is probably the acknowledgement in the ecosystem and the space that regulation can be a good thing, right? Regulation, if done right, can actually help a sector, an ecosystem to develop, to establish itself, and also to be legitimate. So I think to start this whole conversation, that's probably the most interesting comparison point between what was happening a few years ago and what is happening now, where instead we are finally happy to be regulated in this sector. We're welcoming good regulation and good regulatory framework that bring legal clarity to this sector, because that is what then allows this sector, allows this industry to develop, to be legitimized in the eye of the wider public, and to really show its commitment also operating an environment that still complies with existing rules and regulations. So that's really just to say that from this Wild West of a few years ago, now we're probably, we went through a pretty important, and we're still probably going through a bear market and winter market, right, as we would say. But then, as also Mariana likes to say, I think it's a pretty good way to put it, that we are now in a regulatory spring, in the sense that there is now more and more initiatives, national level, at regional level, but also global level, that are looking at how do we regulate crypto assets markets, how do we regulate blockchain technology and the services that are being developed, how do we look at the regulation of DeFi and all of that. So that's where I wanted to start this, with this quick overview actually of the different international organizations, these global regulatory standard setters that are not really regulators per se, right? Because these global institutions and organizations that now we're gonna mention and describe a few very quickly, these are not, in the end, governmental bodies that have a legally binding effect with their decisions, right? So the point is that these major global regulatory standard setters focus on the development of standards, development of common approaches at global level that then member jurisdictions are invited, encouraged to follow and adhere to. Right, so this is also interesting to mention that now we're going to discuss a few global regulatory standard setters, which is, again, it's important because they are the ones giving a direction to the different jurisdictions around the world. They are the ones somehow putting together some common principles and common standards and rules, but then each member jurisdiction, whether it's a national country or whether it's a regional institution, then has to implement its own, of course, regulations and laws that somehow follow that direction given at global level. So just to mention a few, and I'm sure you may have all heard about them in different ways, but there is quite a few interesting global bodies that are somehow, as we just said, describing, giving a direction to how the regulation of crypto assets should be done or should be achieved in the different jurisdictions. So, for example, two of the most important ones that are especially looking at this, let's say, question of regulation from a systemic level macroeconomic level are the Financial Stability Board and the Basel Committee on Banking Supervision, or the BIS in that sense. That basically, with the Financial Stability Board, was probably one of the first, let's say, major major framework for potentially regulating crypto asset markets. And so, yes, in October 2022, there was this global regulatory framework guidelines, basically, that the Financial Stability Board it put out with the idea of finalizing it actually this summer, with a review then planned for the by the end of 2025. And this is interesting because the FSB looked at crypto asset markets and the ecosystem, and somehow reproduced a regulatory framework or an idea for regulatory framework that somehow a blueprint, that's the word I was looking for, the blueprint for a regulatory framework that is somehow comparable to that of that is currently applicable to traditional funds. So that is obviously something that could be perceived as somehow concerning or an outdated approach. But then there is other rules and frameworks, guidelines developed at global level by other bodies that are actually at least a bit more forward-looking in their understanding that crypto asset markets are somehow quite different from traditional financial markets. The other interesting framework that I wanted to mention here is the one by the Basel Committee on Banking Supervision, and this is really on the basically on guidelines provided to banks and financial institutions on their exposure to crypto assets. And of course, as you all know, this is a topic that is obviously quite interesting and quite important in the markets on how to, to what extent should banks be exposed to crypto assets and to different categories of crypto assets as defined by the BCBS. In that sense, and this is again, an interesting overview of how the traditional global standard-setting bodies are looking at crypto asset tokens and defining them according to their risk, and depending on the risk, then defining a certain level of exposure that banks should have. Going forward, actually, with a couple more interesting global standard-setting bodies that are also probably quite known to our community. First of all is the Financial Action Task Force, and I'm sure this is the one that everyone might have heard about because it's the famous body that put out the travel rule, right? So this guidance on virtual asset service providers that in 2021, the FATF updated with the idea that this travel rule, we're going to look at in a moment, should also be applicable to crypto asset transactions. What's interesting in the FATF guidance, of course, is that this is it still implements a risk-based approach, which is really important whenever we talk about anti-money laundering and control of terrorism financing measures. The principle of always implementing and respecting a risk-based approach, right? So the idea that each level of risk deserves a different level of treatment and regulatory requirements to apply to different risk profiles of transactions or of individuals or risk considerations that each institution could make, right? So it's not that every single transaction presents the same risk, not every single account presents the same risk, and or interaction online, generally speaking. So it's important that any kind of measure, and here we're talking about the so-called KYC measure, customer due diligence measures, those are to be applicable, to be applied based on the level of risk that something presents. So that's important, and we're going to get back to that later on when we discuss the AML, this package in the European Union. So the travel rule here, I'll just mention it quickly, and we're going to go back to it later on. But it's the idea that it's a rule that actually exists since a long time in traditional financial regulation, which already applies to traditional finance and transactions of fiat currency and assets in that sense. And the idea is that whenever we're transferring assets and currencies from one institution to another, whether it's my Dutch bank to Mariana's German bank, then these two entities, these two institutions, they need to exchange some information about each other, right? So my bank needs to send, together with the transfer, some information about me, and the Bank of Mariana basically receives that, exchange information about her, and they are then, all happy because this transfer of assets was accompanied by this information and can be somehow identified and pinned to someone, right? And the idea here is that if there is a certain risk, if there is some money laundering activity that is perceived, then the banks are able to see who's transferring money to who. We're going to get back to that, as we said later. The last international global standard setter that I wanted to mention is IOSCO. IOSCO is also a very important global body with a lot of jurisdictions, so it really covers almost the whole globe in that sense, and defines very important rules for dealing and regulating securities and other considerations like that. Well, anyway, IOSCO has been looking very closely at the crypto asset market. They have now already published a first consultation paper just last month, at the end of May, on how to the potential regulatory treatment for crypto and digital assets more generally. But the one that we are all waiting for actually is the consultation report and consultation that the IOSCO will publish by the end of the summer on DeFi. And DeFi regulation, of course, it's a very interesting topic that we will mention briefly, but this is not going to be the focus of today. What the focus of today is supposed to be is actually the EU regulatory message. And so I'm sure everybody now has heard about, as we say, the MiCA regulation, and so the idea that the European Union somehow decided to take a pretty important move, right? So they decided to be the first major jurisdiction in the world. Of course, there were some other smaller countries, middle states that already put out interesting regulatory frameworks, but really the first major jurisdiction in the world to put out a comprehensive regulatory framework for crypto assets and for crypto asset markets and providers of services related to crypto assets and issuer of tokens, and all of that was the European Union. And so this whole story, actually, it's interesting to mention, but it starts basically back in 2018, 2019. Actually between 2017 to 2018, I would say, which is actually when, for example, Blockchain for Europe, my association, was initially created, really with the idea that, back then, as I said at the beginning of this presentation, it started changing, right? This perspective towards regulation in the crypto asset market started slowly shifting. And from that Wild West in which we were finding ourselves in 2015-16, maybe, we were slowly moving towards this understanding that regulation was good, at least if regulation was done in the right way. And that's exactly why Blockchain for Europe was launched back then as an association with 5 members, and now we are over 25 companies that are being represented at EU level. And the idea really was, well, we want to be there. We want to be that voice for the industry that helps the regulatory bodies, the policymakers in Europe, to get this regulation right. We were actually calling for this regulation. We were, when I say we, it's not just Blockchain for Europe, by the way. So all these other associations that you have mentioned, met probably in these calls with the IOTA community on looking at regulation. There is a pretty nice group actually of associations that have been quite active in Brussels, working together with the policymakers to help them really shape the right regulatory framework for crypto assets. And so that's when this all started. The interesting actual fun fact, let's say there, is that when there was these initial discussions on how to regulate crypto asset markets, and no one was really rushing it too much, right? There was this idea that, you know, it's a new thing. Of course, yes, we should do something, but, you know, why should we rush it? Well, then something happened, and that something was that Facebook, now called Meta, had the brilliant idea of announcing a new project, which was called Libra, with its wallet Diem. And this was basically the project of a stablecoin, right? So a digital asset that was somehow backed by Facebook, issued by Facebook, and provided to Facebook users who would have been able to use that token, this digital asset, to purchase products, to purchase services, to sell services and sell products on the platform, on the Facebook platform. And considering how big Facebook was, because of course, I don't think many of us are still scrolling through the Facebook feed every day now, but you know, back then there was basically a pretty important market share, right? So they were covering quite a lot of users and millions of people. And so the European Union realized that if Facebook, this big, bad, evil American tech company that was somehow able to launch such a digital asset that was allowing users and citizens all over the world to exchange value, exchange products and services online without actually having to go through fiat currencies anymore, right? Because at that point, if you're able to, you know, sell everything or more or less buy everything online through Facebook and, you know, through the Zupac or whatever, the Libra coin, why would you then even need to go through fiat currencies at that point? Why would you go through, need to go through the regular banking system, right? So that's really when this whole thing accelerated. When the European Union saw that there was this concrete risk that if there were no clear rules on how to do that, on how certain safeguards and requirements that the issuers of such big digital assets, stable coins, and all of that. So I'm sure you've heard about all of that in the MiCA discussions. But really, that was the moment when the European Union thought, okay, well, we need to do something. And that's when things sped up, accelerated a lot. And in that digital finance package that the European Commission then put out and adopted in September 2020, we had this marketing crypto assets regulation. We had the DLT pilot regime as well, which is also an interesting pilot framework to tokenize, experiment with the tokenization of financial assets and giving really clear rules on how to do that. And then some of these other files that you see on the screen on the transfer of funds regulation, other proposals that are now still being discussed. And so again, going back to the initial topic, this is how the European Union, with all these different pieces of this major puzzle, has tried to put out together a comprehensive regulatory framework that introduces clear rules, brings legal clarity to the market. And legal clarity, you know, we mentioned already a couple of times, we're going to mention a few more, is this, it's something that really is, how do you say, attractive now, right? It's very attractive to have a jurisdiction which gives you legal clarity, right? That tells you exactly what the rules are, what the rules of the game are, what you can and what you cannot do, which then allows you to operate, right, effectively, and tells you exactly whether your product is going to be defined in a certain way or another, which rules apply to your services, which requirements you have to comply. And once you know that, of course, you have to comply. There is a lot of compliance burden at times, but at least you know, right? At least you know what the rules are. At least you know that if you do something one way, then you know, you're good, and if you do it some other way, then you know, you may have to pay a fine. And that's what's missing in other jurisdictions. I guess no need to name them, but it's clear. It's a clear contrast between a regulatory environment where companies know exactly what they can and what they cannot do, and a regulatory environment where you are not really, you know, given this opportunity to know exactly whether what you're doing, your products, is classified in a certain way or another way, and all that comes with it. So let's try and dive into a bit of this regulatory framework. We're not going to mention everything here, but just the most important things. Especially, we're going to focus a bit on the anti-money laundering package and regulation, but there is also obviously some more upcoming initiatives. The digital euro, which is still not clear whether it's going to be published at the end of the month or not. The first initiative on the metaverse. So quite a lot of interesting files. And as Mariana mentioned in introduction, the latest fight that we have here in Brussels is connected to the data. So we're gonna also talk quickly about that. So I'm not gonna go into the details of the whole MiCA regulation because I've probably heard about it a lot and in other sessions, I'm sure. What's interesting to tell at this point is that we can finally really start the clock, right? So after over 3 years, almost 3 years since the original date of publication in September 2020, we now finally have the official text of the Marketing Crypto Assets Regulation, MiCA, published in the official journal of the European Union, which basically, and this happened just basically a few days ago, actually, I think a couple of weeks ago in June. And so that means that 20 days later, so on the 29th of June 2023, that's when the Marketing Crypto Assets Regulation comes into force. But then that really doesn't mean that the rules apply, because the rules apply after a transitional period of 12 months when it comes for stablecoin issuers and stablecoin rules, and then 18 months when it comes for all the other rules for crypto asset service providers and everything else that it's included in the MiCA regulation. So that's to say quickly on the timeline. But then I think the most important question here is that, or thing to remember is that MiCA doesn't really answer all of our questions. There is some questions that remain open and that still need to be answered. And these are especially the ones that are related to NFTs and DeFi. With NFTs and DeFi, it's more or less the same principle, right? So the text of the Marketing Crypto Assets Regulation explicitly says that NFTs and DeFi are outside of the regulatory scope. But then when you go really and read at the details, especially if you read at the recitals, which by the way, I forgot to update the numbers of, these are the old numbers that you see on screen. But anyway, so the recitals really give you a better idea of how to interpret the full text of the law. And unfortunately, these recitals related to NFTs and DeFi don't really help understand, clarify how to interpret the law, but they pose some very important questions. So for NFTs, for example, the recital, the relevant recital talks about the fungibility of NFTs and the fungibility of large collections. And the idea is that if a collection is issued in a very large number, and no one has defined this very large number, what that would be, but let's say that a collection of 200,000 tokens that more or less all look the same, and that really don't vary that much from each other, beside a different number or something of the collection, and that maybe they all have the same price, and this price is always stable, and it's always $1. Well, then the competent authorities would assess this collection on a case-by-case basis and say, well, this collection of this large collection of tokens that is claiming to be a collection of non-fungible tokens, all different from each other. When you look at it, when you look at the de facto characteristics of this collection and these tokens, well, can you really say that this is a collection of non-fungible tokens? Can one token not really be exchanged with another with no difference? Well, then in that case, and especially if, for example, these tokens all have the same stable price, this collection of tokens will be classified as stable coins, actually, rather than non-fungible tokens. So the idea really is that we don't know for sure what will be classified as non-fungible tokens and thus be excluded from the regulatory scope until we're going to get some more clarification. This clarification will come in the form of guidelines on the classification of crypto assets and tokens according to the different categories of MiCA, which the European Securities and Markets Authority, ESMA, will be developing in the next 12 to 18 months. So that's the so-called level 2 legislation that these authorities are going to be developing to try and help understanding the level 1 text, which is the MiCA regulation. More or less same topic, similar discussion is the one for DeFi. And with DeFi, it's interesting because the European Commission, when putting out the MiCA regulation, said, well, we want to focus on centralized actors. We want to focus on intermediaries because that's what we know. That's how financial regulation usually works, right? It focuses on the financial intermediaries that are taking some of the regulatory responsibilities, the KYC and all of that, and that's where the regulation should focus on. What the Commission said about DeFi is actually, well, we don't know DeFi that well. We don't understand it that much yet. Is not that big yet to really pose such a risk that we need to control right away. So maybe it's better to wait and study more, produce a report in 18 months to really evaluate the DeFi market and evaluate whether a regulation of DeFi is needed, and if it's needed, how could that be done? And so what the MiCA regulation says is that truly decentralized entities, or entities that basically provide their services in a fully decentralized manner with no intermediaries, these entities remain outside of the regulatory scope. Some of this, language in this idea about whether entities are outside or inside the scope is obviously still not very clear, and we're also waiting for more clarity on to interpret that. And that's really the main question that everybody in the industry, in the in our industry associations, but also in the regulatory bodies and so on, is the main question that everybody's asking, right? What does it mean to be fully decentralized? Where does decentralization start? How do you define full decentralization and all of that, right? So these questions are being somehow asked within the industry, but also are being asked by national and international bodies. So, for example, in France, it was first in March, the ACPR that put out a very important consultation questionnaire with a lot of questions, very technical. They're trying to understand, seeking feedback from the industry on how to define DeFi and how to potentially regulate DeFi. Then actually, this is not in slides, but the AMF, the Financial and Market Authority in France, also literally just a couple of days ago, as we, before this recording, published another consultation document or discussion paper, actually, they call it, on DeFi, trying to get some intel and feedback from the industry. And as we mentioned earlier, IOSCO is also expected to come out with a very important consultation on DeFi. So the idea really is that everybody's trying to answer these questions. This is not an easy question to answer, but we need to answer it. And here I'm going to add something that really comes from our engagement with the European institutions and the European Commission especially. So as we said, we appreciated how the European Commission approached the regulation of DeFi and deciding to wait for it and not rush it, right? And that they wanted to at least understand the sector better. But then they are the ones asking us in the industry to come out with our proposals and our ideas, because they know that at some point they will be called to regulate, they will be asked to regulate DeFi. And if they don't have on their table good ideas and good proposals on how to do that properly, then they will just apply what they know. They will just replicate traditional financial regulation that, of course, doesn't apply well for disintermediated financial services. Anyway, moving on, because there is quite a few other things to mention. As we say, MiCA is the most important comprehensive regulatory framework in the world. It's also obviously what is setting out the major framework and rules for crypto assets in Europe. But then there is other pieces of the puzzle, as we say, that are composing this picture of a regulatory environment for crypto assets in Europe. So the other file that was already adopted together with MiCA will come into force and be applicable together with MiCA is the transfer of funds regulation. And the transfer of funds regulation, the review of the existing transfer of funds regulation, which was already existing in the European Union, is exactly what we mentioned at the beginning. when they basically the implementation by the European Union of the travel rule by the FATF. So the idea that this, transfer of assets that we were talking about in the traditional financial world, where there is accompanied by information on the originator and beneficiary of a transfer of assets, should also basically be the same in the crypto asset market. Sorry. So that's basically it, right? So the idea that this rule needs to apply to crypto assets. Now, this was quite an interesting discussion actually in Brussels here in the European Union, and the center of the European Union, and where the different institutions are located, because this is where we first started talking about self-hosted and self-custody, right? We started understanding and explaining actually to the policymakers the difference between custody, custodial wallets, where there is an entity that is custodying your assets, and self-custody, right? When you are the one in control of your keys, so your keys, your coin, and that. So when we started discussing this, and the issue of self-custody came out, the European Parliament actually perceived self-custody and self-custodial wallets, or self-hosted wallets, as they're called in the text, to be basically the gateway to illicit financing, to be the one main reason why crypto assets markets are perceived to be full of money laundering activities and things like that, because they have the fear that anonymous wallets where there is no KYC and where everybody can just create a new wallet with a new key and all of that, this fear that this will be the way for criminals to move money around without being captured, without being picked up by institutions and by law enforcement agencies, right? So that's when we also started talking about tracing of assets through blockchain analytics. And this is also an example that we always make when talking about this, and how important it was, for example, to show to the policymakers in the European Parliament how blockchain analytics concretely work, for example, how to open a wallet, how to transfer assets. We had a very interesting workshop in the Parliament, and we showed them, we really concretely showed them on screen how to trace funds with blockchain analytics and how that whole thing works. And so in that sense, when they saw concretely in front of their eyes how this whole thing works, then it was in-house the discussion, and we saw the effect and the impact of that, the positive effect of that in the changes that then were made to the text of the transfer funds regulation. But generally speaking, just to tell you what the real issue there was, the issue was about this idea of verification of identity versus identification. And so I'm not going to go now into the whole details of the whole process, but basically the idea is that the Parliament wanted to request, force verification of identity of the owners of self-hosted wallets, which obviously did not make sense, because there is no KYC when you're opening a wallet with a software provider like MetaMask, right? You're just always simply using that software, and MetaMask is just providing you with that software. So MetaMask is not going to ask you for your ID to prove who you are. And so this idea of verifying the identity just didn't make sense. We managed to push back on it. Now there is only a requirement, a risk-based approach. If you remember, we mentioned it earlier, a risk-based approach requirement to identity verification, which means that if there is a real risk for money laundering, because something was picked up by blockchain analytics tools or other services like that, then a regulated entity would be then maybe required to apply different measures, including potentially asking for documents. But on a regular basis, when we are transferring assets from a regulated entity, an exchange, right, an intermediary, to a self-hosted wallet, well, then there is not going to be any requirement to verify the identity. It's just going to be a requirement to collect some information, so the name of the owner of the wallet and their address, and that's it, right? The wallet address, of course, I mean. But this is just information that will be collected for potential investigations later. There is not going to be any requirement, of course, to verify this information. So that's very interesting how it turned out to be. But this process, this concept actually, and these issues are now popping up again in the discussion in the anti-money laundering regulation, which we're going to go into in a moment. What's actually interesting to mention to close on self-hosted wallets is that the European Banking Authority and the Commission will actually produce a very interesting report by the end of December 2024 to assess the risks of transfers from to self-hosted wallets, which is definitely going to be an important moment to understand how the future treatment of self-custodial solutions will be in the European Union. So getting to the anti-money laundering regulation, this is another part of the anti-money laundering package. For the first time, these anti-money laundering rules in Europe will become somehow harmonized at European level through a regulation after being done through directives until now, which that there is quite a lot of discrepancy actually between the different European member states, how anti-money laundering rules, definitions are applied in the different states. But now with the regulation, we're finally going to have a harmonized rules that are the same across the whole European Union. And now this file is currently in the final stages of the negotiations, which are called trilogues, where the three institutions are basically sitting together to try and find a compromise between their three different positions. This process is actually taking a bit longer than we initially expected. There was an idea that this would have been finished by the end of June, but it's not going to be finished by the end of June. It will actually spill over into the second half of the year, where there's also going to be a change in the presidency, the rotating presidency of the European Union. Right now it's Sweden. The second half of the year will be Spain. Last week when we had this recording, actually, there was a political trilogue discussion on NFTs and whether NFT platforms should be included in the AMLR. This is interesting because, as we said before, just a few minutes ago, MiCA, also the regulatory framework in the European Union, excludes for now NFTs, right? So we say NFTs unless it's a large collection and all of that, but generally speaking, NFTs are outside of the regulatory scope. So there is no rules that so far apply to them. But then again, the European Parliament in this case is pushing to basically close this legislative gap, they say, where NFT platforms are not included in the regulatory scope, and there is no KYC that you need to do when you sign up to an NFT platform and so on. So there is this idea, which we're not very happy about, of course, that all NFT platforms, all NFT service providers should be somehow included in the AML framework. But more to come on that as the discussions move on in the second half of the year. So the main aspects of the AML regulation, as we said, is this harmonization of the anti-money laundering rules in the EU. It builds, of course, on the definition provided by MiCA, and so it includes all crypto asset service provider, the CASPs, as MiCA called them, in the list of obliged entities that need to be compliant with the AML regulation rules. The key issues, the one I mentioned, of course, is the platforms providing NFTs services that could become obliged entities. But the other interesting, important issue goes back again to self-hosted wallets and self-custody. And this is then interesting for the idea of merchants, so professionals that want to sell their products, sell their services online, and they want to do that through custodial solutions. So basically saying that I want to sell my bottles of wine from Italy. I want to sell them online, and I want to ask buyers to basically send me crypto assets on my MetaMask, right? And so I could do that. I could, of course, use my MetaMask account on my website and say, if you want to buy my wine, just send 500 euros of USDC to my MetaMask, and I send you the bottle of wine. That could work. But then as soon as the price of what I'm selling goes over a certain threshold, then I cannot do that at that. I will not be able to do that because the idea is that the AML rules for the first time introduce such a similar limit and threshold also for cash payments. This is not something that existed before the European Union, like this, each state a different one. Now there will be a European-wide threshold for cash payments, which basically says that you cannot sell your, let's say, car for over 7,000 euros, most likely. That's going to be the number, or 5,000, still to be decided, but something like that. So let's say 7,000 euros. I cannot sell my car for 7,000 euros to someone that just comes with a bag of cash with 7,000 euros and just gives me that bag of cash and I give him the car. That's, above that threshold, I actually need to ask for ID to this person, because otherwise I am basically facilitating money laundering. I don't know where this money is coming from, and I'm accepting this sum as a payment for my car that is above the threshold, and so I'm not respecting money laundering, anti-money laundering rules. And well, the same principle they want to apply to crypto asset payments, with the idea that if you accept a crypto asset payments over a certain threshold, which is completely anonymous because it's coming from a self-hosted wallet, or you are, just accepting it through your self-hosted wallet, well, then there was no KYC done, and so you're basically facilitating money laundering. So even though the concept in itself is not completely crazy, but then the threshold is the problem. The threshold for crypto assets will remain at 1,000 euros, while the same threshold for cash, as we say, it should be around 7. So obviously that is something that we're not very happy about. And the other aspect, but this is already something that we managed to fight back against, again, a European Parliament proposal that was actually saying that in this situation, the merchant then will be required to always rely on a counter, so on a crypto asset service provider as an intermediary to that transaction, which means that the crypto asset service provider, the exchange or something, or the payment provider, which has a crypto asset service license, so the regulated entity, these will be the intermediary that takes on the KYC requirements and the customer due diligence requirements, and allowing the merchant to accept the payment, knowing that some KYC was done by the exchange or the service provider. Well, we fought back against this because, of course, as you all can already understand, this will centralize everything, right? It will force an intermediary in this intermediated environment. I wanted to be able to sell my services and products online without any intermediary, and then the rule would actually have force me to rely on intermediary to take on these requirements of KYC. So we managed to fight back against this. So that's something that we managed to get out of the law, or at least ensure that the text of the law is open to the possibility that, for example, self-custodial solutions will become one day, thanks to zero knowledge proof, thanks to self-sovereign identity, decentralized identity solutions, these self-custodial wallets, self-hosted wallets, these will still, these will finally be able to be KYC compliant on their own, right? So without the need for any intermediary to do that.